Good afternoon, Wall Street Reporter members. Senior editor Andrew Packer here, back with another interview looking at some of the big picture and other sector down to small cap opportunities that are kind of shaping the markets this year. Joining me today is Dr. Joe Duarte. He's got an MD, started with a background looking at healthcare companies, biotechs, some great profitable spaces to be in, some very fast-paced profits there. And has gone on to do a lot of writing and commentary on investing in general, especially with things like the options markets. Author of a book, Trading Options for Dummies, Trading Futures for Dummies. Glad to have you here.
Well, it's great to be here, Andrew. Thank you very much.
Yeah, glad you could join us today. So let's just get started. Just, 2021, it seems like a lot of the big issues that the market was concerned about, the election, the pandemic, trade war fears, that's kind of all gone away now. What's going to be moving this market higher or lower? What do you see happening out there? What catalysts, if you will?
Well, I'm wondering, I wonder if it has gone away. The election certainly is passed. But COVID, I think, is still evolving, perhaps not as a pandemic per se, as we had several months ago, but in the aftermath. And so I think that's a very important factor to consider what COVID has done and what it will continue to do and how it will affect the markets.
It does seem to be the case because now we're at a point where, hey, there's this vaccine, there's multiple vaccines, we're distributing them. Some of them have storage issues where they need to be kept, below freezing. Some need to, be done twice. There does seem to be a little bit of the we're not quite out of the woods yet kind of vibe. And I can see that really only playing out maybe for the first half of the year, though, before enough people feel like they needed it, they got it, or, enough people sort of have it. There's that feeling of herd immunity, whether or not there actually is, being a different story. I mean, is this really?
Yeah, I agree with all that. And but like anything else, coming from a medical background, I always think of in terms of complexity, and chaos. And if you think about diseases, they're chaos versus complexity, which is like everyday life.
Right.
And so chaos is so unpredictable that you just don't know. But, instead of discussing medical issues, I think what's more important is how this stuff affects the market. And I think one of the things that we're seeing is that not very well noticed by many people, bond yields have been slowly creeping up over the last several months. And now we're kind of at what could be an inflection point, with the U.S. 10-year note yielding about 1.1%. Now, the creep up in yields has sort of slowed, and there seems to be some consolidation now. But if the yields on that 10-year note start creeping up again and get above 1.2%, then a lot of things could happen, mainly two of them. First thing is, for example, if money comes out of bonds and goes into stocks, which is very plausible, then you could have higher stock prices. The other one is, are stock traders going to start worrying about higher interest rates and sell stocks? So I think that the bond market is probably the most crucial aspect of what's going on right now. And of course, it's all tied in to COVID. Do people really go back to work? We had 900,000 jobless claims this week. In 2 months, is that going to be 500,000? Well, that would be terrific, right? People going back to work. But what does that mean in terms of what the economy does and how the bond market responds, and then in turn how the stock market responds?
Yeah, I mean, I'm glad you bring that up because I think a lot of stock investors, they look at the bond market and they're either thinking these rates are too low, I'm not going to invest in it at all. Or just like, who's buying bonds anymore in a world where you're better off maybe buying gold or like cryptocurrency just because the Federal Reserve is just going to keep those interest rates low. And I think a lot of people perceive that they're going to keep it as low as they need to, as long as they need to. And any of this short-term sort of thing, the Fed can just crack down on it if they really need to.
Well, I couldn't agree with you more. But the Fed is trying to control the bond market. They keep buying bonds so they can put money into circulation. But the bond market is telling the Fed, you're not buying enough bonds. So we keep selling and yields keep creeping up. And that's the kind of thing that, we could sit here and nitpick it and it sounds arcane, especially people that are just trying to figure out, hey man, what's my next winner?
Right.
Give me my next 50% gainer. Well, I've got some of those possibly, of course, I'm a stock guy, but you always have to worry, and I remember there was an old guy named Marty Zweig, long past now, great investor. And what he used to say was, the time I'm the most worried is when I'm not worried. So, I always have a worry, and my worry right now is the bond market.
Okay. Yeah, I mean that makes sense. And I feel like the stock market the last 2 to 3 months has been a little bit like the start of last year, January, February, where we just had this kind of just nice solid move up, and then all of a sudden, hey, pandemic, big rush for cash, everything's selling off. And I mean, kind of people don't really realize it, but I mean, bond yields are so low. The flip side of that is prices are high. And when prices are high and expected returns are low, it kind of becomes a disproportionate risk reward for that to go down.
Right. So the other question, the flip side, and it's something that you and I have talked about in the prep for this, is there inflation out there? And the question is, I mean, the answer, as far as I can see, is yes, but you have to look for it. For example, I go to the grocery store, and I used to, my normal stuff that I would buy would run me 40 to 60 bucks. Now it's costing me 80 bucks and I'm buying the same stuff. Now, is that just me or is that everybody? And if you look at commodity prices, some of them are starting to creep up, and so you have to wonder how much inflation is now working its way into the system. And with the Fed continuing to pump money into the banking system, is that at some point going to be the thing that sparks true inflation? And then what happens? Well, historically, stocks tend to do reasonably well with it during inflationary times. I mean, people flock to them because they're a reasonably good hedge against inflation. So it all seems to be related. Bonds, inflation, and how the market responds. And if you think of the market as being the central piece in the economy now, which I do, I mean, most people look at the economy and the markets as separate issues. They're not. I think they're now one thing. Many people have derive a significant amount of their income from trading now, which didn't used to be so much the case. And a lot of people make financial decisions based on their 401k plan. So the stock market plays a central role in people's financial decisions now. And so again, same thing is, if interest rates start to creep up, what's it going to do to the whole thing?
I mean, that all makes sense. And I mean, if you're talking inflation, I mean, what is the stock market going up but a potential sign of inflation? I feel like this crisis and the last one, the Fed has really figured out, if we're pumping money the right way, it's going to go into the stock market and that'll go up and people will feel better and they'll feel wealthier. Or it might go into home prices. Same thing. People feel wealthier. Their home's worth more, as opposed to that money going into, say, food prices or commodity prices. It seems like there is sort of a fundamental demand that's still a little weak on that side.
Well, I agree to a certain degree, but if you think about it, people are taking the money from the stock market, and buying things with it. Is it homes? To some degree, sure. But in some cases, it would not surprise me if you actually ask people, the man on the street, did you take money out of your 401k to pay bills? People borrow from their 401k plans increasingly these days. Or are you buying it? Are you taking money from that to buy groceries? How long before you putting it back? And or do you have a trading account? What are you doing with the money you're making on your Robinhood account? I mean, that's the hot thing now, as you well know. Robinhood
Right.
and day trading drives stock prices higher. So I think there's a lot more to that dynamic than people realize, and that's why I worry about interest rates, because it's unknown. I mean, the book has been rewritten, in my opinion. COVID changed everything. People's perceptions about life, work, and perhaps even inflation. And really, nobody knows what the Fed is truly thinking. What are those guys up there? They have access to information that most of us couldn't even imagine. What are they seeing that continues to make them act the way they're acting? So there are a lot of unknowns. So what I do is I take all that, I of course factor it in, but I look at the market. I look at price charts, and when I see certain movements, then I either buy or sell or stay away. But to me, the market itself now, more than ever, is the central cog in the decision making, not just to buy or sell stocks, but for the economy and for a lot of people's daily lives. And they may not realize that. That may not be a conscious part of what they do. But I think that that's now, part of daily life. And I'm not sure it's going back to where it used to be, that people used to not factor that in.
I mean, I sort of agree with you, but I also feel, looking at this market and in the last year, just kind of this explosion of day traders and retail traders, it's a little bit kind of like the late 90s, that first wave of people who became day traders, except now they're much more focused and they have sort of time and energy to be. So, yeah, I mean, that's when I was cutting my teeth and sort of learning, like as a teenager, it's just, here's how the markets can be played. And there's a lot of ways to play the markets that work, and plenty of day traders who have figured out kind of the rules they need to do well, and others who just kind of see a market going up, jump in on it. And look, luck's always going to play a role in the stock market, but kind of knowing how to manage risks, I feel, is something that people should really be looking at.
I mean, I couldn't agree with you more. And that's one of the things I talk about in my options book, Trading Options for Dummies. Options are not for speculating; they're for risk management. And you should use them not just to try to make money, but to manage your risk while you're making money. And obviously, you can use them to hedge your portfolio. But even in an options trade, you should hedge that trade one way or another, either by setting limits on your gains, or putting a sell stop under it, or doing a more complex trade like a spread or something. But it's all about risk management, and the same thing it applies to stocks. You want to have that that risk management. The same thing. Put a target on it. I bought the thing at $30. It goes up to $5. It goes up to $35. Well, what am I going to do? You should know that before you make that trade, before you push that button. Am I going to take half of the position off? Am I going to take 10% off? Am I going to add? Where's my sell stop? Right. All those things are crucial to successful trading.
Right, because if you don't, your emotions might say, oh, this thing that's been going up is going to keep going up, as opposed to, hey, I've made enough money, I've got other opportunities. Having just a little bit of that rational kind of view to it makes sense. And also knowing when to recognize, hey, this company is doing better than expected. Things have changed. I can change my outlook. It's not like you're permanently fixing things in advance, but you should be, periodically just making sure things still line up with.
Right. You have your trading rules, and that's where you start. And then obviously every good trading plan gets adjusted. So one of the rules that I focus on, and if anyone looks at my other videos on YouTube and that sort of thing, I always have my trading rules. And one of them is, obviously you don't want to fight the Federal Reserve. This is obviously true now more than ever. You want to trade in small lots. You don't want to be trying to hit home runs. If you're someone that likes to trade 400 share lots, well, you might want to trade in 200 share lots. That kind of thing. If you're a 50 share lot person, then maybe 25. And when the thing goes up 20%, there's nothing wrong with taking something off the table. Nothing wrong at all. You can keep some, but if you take something off the table, then you've got some in your pocket. And use those sell stops, 5 to 8%. If something drops 5 to 8%, you really don't want to be in it, at least not now. It could bounce back, obviously, and you might want to re-enter that position. But, have those trading rules so that you have money to continue to trade. That's where inexperienced traders get into trouble. They get some success early on, and they forget or they never had trading rules, and soon they start developing them. Because it hurts when you get trashed. So.
Right. And I mean, there's nothing more frustrating than building up a portfolio over, weeks or months or, even years in a bull market, and then have one or two events that just wipe out those gains quickly. So good idea to have those rules. So, I mean, let's talk a little more about kind of your strategy. Like, what are you looking for? What kind of factors do you consider when making an investment?
So the first thing I do is I have over time stopped looking at the market in terms, the general broad terms market in terms of indices. I look at the New York Stock Exchange advanced decline line as my primary trend indicator. And the reason for that is the trading algorithms, the robot traders that everyone has heard about or knows about, they do 80% of the trading. And, they can affect the prices of indices and exchange traded mutual funds just by the way they trade. But they can't really change the number of stocks that are advancing and the number of stocks that are declining. So that is a pure sign of the actual trend, And so what I also do is I apply technical analysis to the advanced decline line. So I use the 50-day moving average as a guide. And when the advanced decline line drops below that 50-day moving average, there's a good chance it's going to drop further. So I couple this indicator called RSI to that. And as long as it stays above 50 and the New York Stock Exchange advanced decline stays above 50, or above the 50-day moving average, then I know I'm in an uptrend. And so I look for stocks to buy. And then, of course, you're always running screens and scans, and you're looking for those stocks that are looking good. And I like to look for stocks that are about to break above their 200-day moving average. I mean, that's the perfect setup, because usually they've come off getting beaten up for a long time, and they're finally making their way back up. So that's really when the money is actually coming in that has conviction. And if a stock takes out that 200-day moving average after a huge decline, usually it will pick up momentum, and those are the stocks that will often deliver huge wins. Of course, it's no guarantee, but the odds favor you, because you got to think of this in terms of psychology. Let's say you had a stock that dropped 60%, for example, from the top, and it's worked its way back up to the 200-day moving average. Well, that's pretty good buying. But what about the people that bought it when it fell, right below the 200-day moving average, right, on the way down? They're going to want to get out because they're even now, right? So if a stock is able to survive that I'm even, I want to get out of here vibe, then that usually means that the buyers that are coming in are pretty strong. And that's where the momentum usually is. So to me, that's the greatest long-term setup. Now, obviously, that doesn't apply to people that are day trading or anything like that. But I'm not a day trader. I will do some short-term trading, but I'm not a day trader. So I'm looking for that intermediate term. I want to be in a stock if I can for as long as it does well, and usually no less than 4 to 6 weeks.
So you're really trying to kind of swing trade, where you're catching a pretty big percentage move in a stock in a short amount of time, as opposed to day trading, where you kind of start the day in cash, end the day in cash, and if a stock moves 0.5%, 1%, you're happy. But you need a lot more leverage to make that kind of trade successful. So, with this approach, you can buy shares and get a 20% return in a few months, and do that a few times a year, and you're going to beat the pants off the market.
The problem with the ETFs, though, is that the algos are there, and they manipulate that price, on a regular basis intraday. And so you could have, if you're not a patient person, or they whipsaw it around your support level that you're looking to for the stock to stay above, you can get whipsawed ridiculously. I mean, you could have a 20% gainer that, because you're trying to be a position trader, you got shaken out of, several times. That's frustrating. That doesn't happen as often in stocks, that in individual stocks. That's why I don't do very much exchange traded mutual fund trading. Because anything that's directly related to indices, the algos are very, very aggressive in moving the price higher and lower, in a volatile fashion so that they can shake people out.
Right. And the algos in general are just designed to kind of make money no matter what you do. And as long as you recognize that and you're not really playing by their rules of trying to trade, kind of in nanoseconds and get these very small fractions of a move, you got a different business model, you can still be successful. But
they make money. They make money every time. Every time a stock goes up a nickel or down a nickel, they made money. You and I don't. So we have to try and figure out ways to filter their activity. And for me, and I, my subscribers of my on my website, Joe Duarte and the moneyoptions.com, that the filter is that 200-day moving average, and then using the 50-day moving average as well as a guideline. So, going back to what we started, New York Stock Exchange advanced decline tells us the trend. And then we look at the specific trading pattern over longer terms, looking for what I call the sweet spot, which is that crossover of the 200-day moving average with the right mix, and then that's when you see that stock blossom, and often you get a really nice pop that can last in some cases several months. So you could have 3 or 4 good stocks and get huge gains on them, and you could have 10 stocks that you get stopped out of. But if the trend is your friend, then those 4 stocks, the profit more than makes up for the 10 that you got stopped out of. It's old-fashioned trading. It's not right. It's not the thing that a lot of people do these days, but it does neutralize the algos.
Right. I mean, if it still works and it ain't broke, don't fix it. So, I mean, that sounds similar to a strategy I'll use where I'm looking for these kind of oversold swings with even some big blue chip stocks. You can get 20, 30, 40% move on some of these companies in the span of less than a year, which, you look at the longer term performance of these companies, you would not expect that, but it's really just catching that trend and getting at the bottom of the wave and riding it part of the way up and not getting too greedy.
Absolutely. And recently, for example, 2 stocks that we bought on my website, Applied Materials and Micron Technology. We were able to catch them just as they were starting that upswing, and both of them are up pretty nicely in the last 3 weeks. I mean, I'm thinking, and I'm not looking at the charts right now, but Applied Material is up at least 10, 15%, if I'm not mistaken, from that time. I still own it, and we still own it. And Micron was a little bit lagging, but it's starting to catch up. And today they may be having a rough day and a pullback because the market today is, kind of, pulling back a little bit. But the trend remains up. Advanced decline line is well above its 50-day moving average. It's not looking as if it's trying to go parabolic or anything crazy. So to me, today looks like one of those days where, people are actually taking some money out of the market, and we'll see what happens tomorrow.
Fair enough. Yeah, I mean, it's interesting too, AMAT, Micron, these are just both semiconductor stocks. I mean, that's a very strong performing sector when it does well. It can have periods where it languishes. I mean, I've looked at Micron over the years and, full disclosure, I mean, I bought shares at like 50 and, now it's run up to 80. But I mean, I could have bought $50 shares on that like a year ago, 2 years ago, 3 years ago. What separates kind of that back and forth move from a big move higher?
Micron particularly has the ability to explode. I mean, over the years, I have traded that stock many times, and some of the time it goes nowhere, or you get beat up a little bit. But if you catch it in one of those times when it's going to go, it can be a very profitable stock. So that's where the trading rules come in. And that's one of the things I also recommend that people do, that you get a group of stocks that you really get to know. that you start realizing what their movements can be like, what their price ranges, what their behavior is in terms of what are they likely to do when earnings reports come out. How do they respond perhaps to an interesting report? Are they related to, do they go up when the employment report comes out? Those kinds of tendencies. And you don't have to sit there and do statistics and things like that. You can just study the charts and study the price patterns and start to develop a feel for this stuff. It doesn't, you don't have to be an algo. You can look at these things from a macro, soft standpoint, for lack of a better word. But it comes in very handy because if like I have about 50 stocks that I look at every day. And, Applied Materials is one of them. Micron's another one. Things like Texas Instruments. I look at those things all the time, and I have an idea as to where they are in their price cycle. And when I see what I like to see, that's when I buy them. And of course, you always look for new stocks and new things that are happening. But it's not a bad idea to have that 20, 30, 50 stocks that you look at all the time and you're very familiar with.
Right. Now, let's talk strategy a little bit. Say you identify a stock you like, you do a lot of options trades. What are you looking for kind of in an options trade versus buying the stock? And how do you select what you feel is the right option for that trade?
Well, it's options. Options are very tricky compared to stocks these days, again, because of the algos. So that's the first thing I think about. Now, if there's a stock that's trading at $200 and it's hitting that sweet spot, my first thought is I'm going to try and see what the options are doing, because I don't really want to, buy, 50 or 100 shares of this thing and put that much money at risk. So the way I look at options is I look at the underlying stock. This stock looks pretty good. Is this thing optionable? And then of course I look at the volume. Is 5 contracts traded, and 10 contracts a day. Well, I don't really want to do that. Those are thinly traded, and there's, if the stock goes down, 50 cents because it's so thinly traded, the options might fall extremely exaggerated, not as the options model might predict. So you look at the underlying stock, and then you look at whether the option is thinly traded or not. If it's got good volume and it fits your criteria, then it's okay to do it. My favorite option strategy is actually covered calls. Because there's a little bit, there's certainly a potential for income, and there's a little bit of a hedge built into it. So you have a little bit more time. And of course, excuse me, when you buy a covered call, when you do a covered call trade, there's certain criteria. 45 days till expiration is really the key. If you put together a covered call or a buy right strategy greater than 45 days, then the time decay doesn't work in your favor. Because the real goal is to get that option to either go up a little or go down a little, but you don't want it to be moving in a very volatile fashion, because then it just wrecks your trade. So you look for a stock that's kind of basing, and a stock that has done that over the years for a long time, and that might be ending now, is Gilead Sciences. And I think we talked about Gilead Sciences the last time I was here because it was a hot COVID stock.
Okay.
But that's a stock that, for a long time just went sideways from 55 to 65. If you caught that thing in the right place, you could make a lot of money selling calls. And even if the calls only generate $100 to $150 per run, over time, that adds up. So otherwise, you can do more complicated trades, spreads and condors and all those things. I personally don't do those because I don't have the patience for them. And I can't sit there and watch the thing go crazy. It makes me impatient. And I go, well, my gosh, this thing went up, or down, and I go, and I end up killing the trade. And then, 2 days later, the trade just went great. I'm kicking myself. So buy right strategies, straight calls. Those are the kinds of things that I usually will do in my own trading. As far as puts go, that's risky stuff, especially in a market like right now. It keeps going straight up, and you think Tesla's got to crash, right? I'm going to buy those puts. Well, Tesla doesn't crash.
No, it just slows down for a bit and then just keeps going.
Yeah,
so, yeah.
right. So puts are kind of a something that probably works very well for hedge funders that have billions of dollars that they must protect. But
And
for the average person, for the average person, you can buy straight calls if you think a stock is doing well. Choose wisely and have your trading rules, and look for stock that's basing and going nowhere. And that's great for selling covered calls.
I mean, I'm glad you mentioned that. I mean, as a tool, just because I've done a lot of work with doing covered call writing on positions over the years. Usually after they've had a big run up after I bought them, rather than the buy right, because your returns there are kind of a lot more limited if it ends up going a lot higher. But after a stock's had a big move higher, even if you think it's going to keep going, like it'll usually pause and consolidate. So that's a perfect strategy for that. I've also done a lot of work
because you're paying yourself. Well, you're paying yourself for being patient is what you're doing in that case.
Right. And I mean, with like a dividend paying stock, if you're doing the covered calls right, even if you only do it a few times a year, if you bought it for the income, like you're going to be able to double or triple that without really adding too much risk, even of being called away.
Yeah, and a lot of you also must be willing to end the trade before expiration. That's one of the things, because you don't want to have a trade that and people talk, well, you only made $100. Well, you only have one contract and your total risk was like about $4,000 or $5,000. That's not too bad for just sitting there. I mean, if you were just holding the stock and it's down 50 cents, you lost $50. So you're actually up some. At expiration, things can get kind of crazy, and you might be the unlucky guy that gets assigned. So if you've got some money in the bank with a covered call, and even though it's not a great deal of money, there's nothing wrong with closing that trade out, taking that profit, seeing what happens over the next few days, and if you want to put it back on again, go ahead.
Yeah, it's also good too to like close it out around earnings, because that can have a big move or some company announcement. Absolutely. That might be coming out, especially like a tech company. They might be saying, hey, here's when we're doing our investor presentation day, and it's nowhere near earnings, but you can still have some big swings.
Right. The other thing around earnings that you could certainly do is a straddle, where you buy the call and the put together and you see what happens. The problem is that some of the time nothing happens. And so your option trade collapses because people start selling because nothing happened, and you lose money on both sides. So if you're going to do that, you want to put the trade on with a stock that the odds are going to be huge of something popping, one way or another. Like Netflix is a great straddle stock, and Amazon can be one as well. Of course, to put $1,400 down, on either side on Amazon, hoping for a big payoff on earnings, that's a lot of money to wager on an options trade, in my opinion. But if you got that and you're, and that works for you, then those are the kinds of stocks you put the straddle trades on.
Yeah, those all make sense. And I also want to bring up put selling. That's kind of the flip side a little bit. And it's one that, in this market where we're probably going to keep trending up for a bit, maybe not that quickly. It's a similar principle to covered call writing, except for you don't own the stock. Is that an area where you do any of that work, or is that just sort of too risky, too much capital involved?
Personally, I don't do that trade because if it goes against you, the risk can be pretty significant, even with one or two contracts. And I'm very risk averse. Like I'm one of those guys that if I managed a mutual fund, I would always have 40% in cash. People would be going, "What are you doing? You're a mutual fund manager. You're supposed to be 100% invested all the time." I couldn't do that. So more than anything else, the first thing I do is look at risk. And if I look at something, I go, man, if this thing goes south, I'm going to get wiped out, and I just don't do it. But again, it is a viable strategy because really, when you're selling an option, you're basically tempting the buyer, and your goal is to sell them something that is going to be in your favor. So in this market, selling a put, why not? The odds are not very high that the market, or the particular stock is going to, you know, get clobbered. So that's theoretically easy money, unless of course, you know, it's that one day where it goes crazy, and that's why I'm very cautious because on any one day the algos can just go crazy, and you can just get wiped out.
Fair enough. So I mean, those are all good factors to kind of think about there. Now, I mean, you did mention kind of before we came up that you had sort of a presentation. You had some kind of ideas in terms of market risk, looking at kind of how chaotic markets can be. I feel like that's an important part of your process, so I want to make sure that we get to that.
Well, and I'm hoping that the technology works. So I mean, basically, we've gone through most of it already, without the slides. But you know, but basically, what I always tell people is that I think in terms of complexity and chaos, and complexity is when everything's going right, and chaos is when everything is going wrong. And so I think of complexity as the cliffs of Dover. A nice seaside scene, and everything is right. The sea is doing its thing. The breeze is blowing, and things are correct. Chaos is when you get to a hurricane, and everything is wrong. And so I like to look at things in terms of are we in the complexity zone, or are we in the chaos zone? And so when stocks are above the 200-day moving average, essentially they're in the complexity zone. And when stocks are under the 200-day moving average, they're in the chaos zone. And the 200-day moving average I think of as what is called the edge of chaos, which is where there's just enough complexity and just enough chaos together to make the situation potentially explosive. Okay, so and that helps me to make better decisions. And I'm not trying to be a scientist, but there's a great deal of scientific work now in complexity and chaos. And I think that's a good way to organize this stuff. But beyond that, it's really all about the Federal Reserve and money flows and finding the right stock. The biggest challenge right now in a market where there's potentially a rotation going on is finding the right group of stocks to own. The Fed's on your side. The advanced decline line is moving steadily higher. So you're in a bull market. The problem sometimes is finding those stocks, especially on a day like today where everything is just seeming to be sloughing off. Today, a day like today is a difficult day in which to buy stocks. But as soon as they find that support area around that 20 or 50-day moving average or whatever, and they start popping back up, those are the ones that you're going to want to get in on, because the trend is definitely on your side at this point.
Okay. Now, we already mentioned Applied Materials, Micron. Are there any other areas or sectors that look attractive now?
Some of the housing stocks are an interesting area, and I think that whatever happens to the housing stocks over the next week or two will tell us a lot about where the market is going. they had a really difficult time here over the last 3 months after having a big move in 2020. And as interest rates have started creeping up, they've been suffering. But here over the last couple of days, they've tried to bounce back. And so if they're able to bounce back and make new highs, then I would become a lot more bullish on the housing stocks than I have been over the last several months. Housing starts are starting to bounce up again. And, our interest rates, historically, interest rates are extremely low. Are they low enough still to where people are going to want to take that chance on that mortgage? And is 1.5% on the 10-year note okay for mortgage rates? But I would put mortgage rates probably around 2.75%, 3%. Is that enough? Is that low enough for people to still buy houses? So the housing stocks, I think, along with the bond market, are areas that I'm looking at, but not ready to jump back in on at this point.
Okay. What about the commodity space? That's an area where, with kind of the inflation trends you see potentially playing out, it seems like there could be a lot of big moves there, especially with some of the smaller cap companies that are out there.
Yeah. And again, those are difficult to catch the wave on because many of those stocks are thinly traded. So if you're going to own any of those, you need to be very patient. One of the food areas that I've looked at, which is commodity related, is like Hain Celestial. HAIN symbol. They do all this organic stuff and all this healthy stuff, and those are really big trends in the food area. But the stock is very volatile, and it's hard to trade. And if you go on the other side of the aisle, at Archer Daniels Midland, they're the food behemoth, commodity behemoth, corn, and everything else. In fact, they're becoming a food additive stock. So most people think of Archer Daniels Midland as a company that trades along with the corn market, but in fact, they're changing their business model and have been doing so for the last couple of 3 years. And they are doing just fine and on that side of the business. But then when you bring in the commodities with their volatility, their earnings, don't always measure up. So again, the stock is really difficult to trade. Right now, Archer Daniels Midland is in that zone. Where is it going to go or is it not going to go? And full disclosure, I own a few shares of it in my own account, but I haven't put it on for my subscribers yet because of that herky jerky trading pattern.
Because it's sort of in that zone where it could really not necessarily offer the best returns, but could still shoot up. Is that a fair assessment?
Yeah, right. So one of the ways sure, but one of the things that I've done and we've done very well with has been the restaurant stocks. Okay, that's kind of a commodity play in a sense because obviously food costs affect their bottom line. But we've done very well with Brinker International. They own the Chili's and Maggiano's chains, and it's a very interesting stock. Restaurants are at low capacity and so on and so forth. But these guys, management actually did something very smart. They started a wings delivery restaurant in a joint venture with DoorDash. And that's doing very well. And there's a couple of Chili's around my house, and once in a while when I don't want to cook or whatever, we go. Their to-go parking is packed, and here in Texas, where it's not so much a lockdown state, the dining rooms for Chili's are full to capacity, with the social distancing limitations. So, that's a company that's doing well. And if you look at that stock chart, it's just nicely moving steadily higher, So if you're going to do commodities, you want to find the right angle. That's certainly my opinion. I like I said, I'm very risk averse, and I like to look at things sometimes 2 or 3 steps away from the center of it, but still having a relationship.
Right. I mean, even McDonald's, for the amount of beef in their hamburgers and what they're selling them for, that's a big value add versus just buying, just kind of like beef futures. I mean, just one way of looking at it. So
That is one way of looking at it. McDonald's, that stock's kind of pricey still though. I mean, you can buy Brinker, for $60, and McDonald's is still $100. Uh, or generally in that price range area. And so again, it's that value. It's that hidden Warren Buffett. Am I going to get that? Am I going to get something on the cheap that's a diamond in the rough?
right. Yeah, and I mean, McDonald's never closed their drive-throughs, whereas restaurants that didn't have them, they had to kind of shut down and figure out how to stay in business with takeout and then partially reopen in some places. So that is definitely an area with potential.
Yeah, I mean, and it's not all restaurant stocks. Some of them are not doing very well, but some of them are doing better than others. And so it comes down to management. What kind of decisions have they made? How have they adapted to, again, bringing in this post-COVID world, for lack of a better descriptive word? I mean, it's not post-COVID yet because we're not obviously completely out of the woods, but it's been around a while now, and people have had plenty of time to adjust. And those that have adjusted accordingly are doing better than those who haven't.
That's a good way to put that. But it also seems that part of this kind of COVID issue has been the Fed putting interest rates back at zero, throwing money at the market. A lot of people are fearing, kind of that inflation, are kind of keeping an eye on the bond market. People really flocked into like gold last year, and it's come off a bit. Is that something that can keep trending higher?
The gold market is probably the quirkiest and most difficult market of all to trade. And I'll tell you a funny story. When I started trading back in 1987, and I'm clearly showing my age here, but first trade I made was a gold mutual fund. I was sure that after the stock market crashed and everything else, gold was going to go through the roof because there was a crisis and so on and so forth. It didn't do anything. And every time I try to trade gold, I can't, for lack of a better word, I can't catch the wave. It's a tough market. It's very tough because every time you think that it's about to do something spectacular, it doesn't seem to. And then you look back and, in a couple of weeks after you gave up and the thing's up, $100, and you go, how the hell did that happen? I mean, what did I miss? So can gold go higher? Yes. But it's got a lot of competition from Bitcoin. A lot of people think that Bitcoin is the next gold. And I'm not sure that's right or wrong, but at this point, aside from the current volatility in Bitcoin, and it's breaking support levels and bouncing back up and whatever, a lot more money's gone into Bitcoin lately than gold.
I mean, it's got a lot of the same arguments as sort of that inflation protection, government money printing protection, and even the gold bugs. Like, you've got to admit, central banks are the biggest owners of gold, and they could flood the market, or they can support just kind of the big banks, and the big banks can just put out paper contracts to kind of push the price around. Whereas, for now, at least, Bitcoin's designed to be this completely decentralized thing, although there are a lot of kind of those big traders out there who probably could move the price if they wanted to. So it is sort of the central bank, or these big Bitcoin holders you don't.
Well, BlackRock, I was just reading a couple of days ago, has just decided that they're going to get into Bitcoin. That's going to do something to the price, I'm sure. Unless, of course,
last year it was PayPal and Square and kind of the more retail focused, and now this is getting more institutionalized. So, I mean, that is, I think, definitely, it's a potential driver, and people realize, hey, here's this, asset. It's all digital, but there's a very limited amount of it. I better make sure that, my clients have enough of their, portfolio to it before it's, too late.
I think the story on Bitcoin it remains unwritten, to be honest with you. Well, and I think that's going to have an effect on gold. There's no doubt about it, because if it becomes, the preferred hedge against whatever crisis, and think about this, right? If someone is selling bonds, are they buying Bitcoin with the proceeds now? Is that why we're seeing interest rates creep up in the bond market? Is Bitcoin becoming the new run to when things get bad asset class? That used to be treasury bonds, and it may still be treasury bonds.
Yeah,
we don't know yet.
We saw with last year's market sell-off, though, first the stock started going down, then gold started going down as people were getting out of that trade. And Bitcoin was the last to go, but it did have a big drop. So eventually I think people do want cash equivalents in a big market sell-off. So I guess my question for you then is, what is going to separate kind of the next market pullback from a big sell-off?
Well, I think we have to understand what can trigger the next market sell-off before we talk about, the sell-off itself. And the meaningful market sell-offs of the past, 20 or 30 years have always been related to problems in the bond market and the currency markets. Okay? If you start seeing problems in bonds and currencies, then eventually the system starts to weaken and other asset classes follow. And at this point, that's a tough one to look at, because bonds are selling off, but it's not a huge, crazy, aggressive sell-off. And if you look at the dollar, which regardless of all the talk that the dollar is dead, it's actually starting to get a little bit of a bid under it. The dollar index is now hugging that 90 area, which is historically the pivot point between good and evil, for lack of a better word, on the dollar. So it's a tough thing, but at the end of the day, if the Fed starts to raise interest rates, just look out below. I mean, no matter what. And that's been proven. Every time the Fed tries to stop the QE, they roil the markets. So if they start saying, we're going to start tapering and start actually tapering, just go home.
Yeah, I mean, I know a few Fed governors have talked about when that could happen, but I feel like that's years off, and we're kind of back to that, 2009 to 2012 kind of market where any talk of that's going to cause a bit of a sell-off, and then they're going to back off from it, and the market's going to keep kind of gradually following that long-term uptrend that it does.
Until they do.
Right.
Because at some point, they will try it. Now, I mean, that's what scares me.
Yeah. I mean, they started raising rates 2015. They got up from 0% to 2%, and then they had to just cut it right back to 0. So, every time there's a crisis,
I don't think they can, to be honest with you. But I don't think they can.
It'll take years, I think, before they even think about it. That's kind of the issue. And what's the economy going to look like by then before that happens? That's kind of also kind of the next big question. Coming up on the top of the hour here, what other kind of, ideas are you looking at? What are kind of like just the top things that traders should be looking at to kind of hone their skills and, be better prepared for, days, not like today, but, actually big volatile days that are likely going to lie ahead?
Well, I think the number one thing is to put a sound trading plan together and to hone it as things develop. But have those 4 or 5 principles that you can go to. Like I said, don't fight the Fed, don't fight momentum. Have those 50 stocks you look at. Get to know their characteristics. Brush up on your technical analysis. See what those, what the 20-day moving average, the 50-day moving average, what those things mean, how they affect your stocks. And above all things, I can't say it enough times. The markets at this point are based on the Federal Reserve. Keep a very close eye on what the Federal Reserve does. If they start tapering or wanting to raise rates, or the talk becomes really hot on that, expect a lot of volatility and, follow your trading rules.
That's just all good advice, no matter which sector you're in, large caps, small caps. All this data is available for free. It's easy to find. Even on like stock charts, you can play around with some of the stuff there. Lots of functionality. It's really added over the years.
Sure.
You don't need a Bloomberg terminal like 10, 15 years ago. But.
Right. So, and again, if you're interested in more of this kind of stuff that I do, go to YouTube and punch up Joe Duarte and, a bunch of videos where I actually talk about, the advanced decline line and how to pick winning stocks in any market will come up. And you can certainly glean a lot of information from that.
Right. And then you've got your website in the No Trader. Any other places where people can reach you and kind of learn more about what you do?
Well, certainly. My website is joeduarteinthemoneyoptions.com. You can certainly go there. And we have an ongoing free trial program. You can just give us your email and get in there and, have a look for a couple of weeks free of charge. After that, if you want to subscribe, please do. Number one. Number two, if you want to read my my weekly newsletter, sign up at the website as well. Or if you're a stockcharts.com subscriber, you can certainly look at it there. I offer that to those subscribers as well. Beyond that, you can buy my books, Trading Options for Dummies and the Everything Guide to Investing.
All right. Well, appreciate you taking the time to discuss kind of these big picture views, how to become a better trader, kind of hone those skills, especially kind of before, markets might maybe start making a big move up or down again. Thank you very much for the time today.
Great. Look forward to the next time.
Yeah. And thank you to our viewers here at Wall Street Reporter. I am senior editor. Until next time, Andrew Packer signing off.